All right, what's up? Let me go ahead and make sure everything's going good. I'm still getting used to the Streamlab shit. Cool. So we got interest rate decisions coming up at 2, and then we have 2:30 is when JPA actually speaks. So we got like 30 minutes to burn. So let's see, we'll refresh it, keep it refreshing. Sometimes Forex funds will, or not Forex funds, Forex Factory will auto refresh, but we'll watch. So we'll see how this comes out. It's gonna be interesting. Now we hit one target on the Bitcoin longs we gave in the server. We've been in them for, I don't know, like almost 3 weeks now. Yeah, now a little over 2 weeks. I round up whenever I've been getting eaten alive by swap fees. That's one lesson I learned with trading on my Forex funds for the these kind of longer term trades. Can eat into your profits. And it's still a pretty good trade nonetheless. So I'm happy with it. Also, hold on, I see flows in here at the mic. I'm muted. I don't even have my headset on.
Yes, sir. What's up, my boy?
What's good? How you doing?
Chilling, man. Chilling, man. 30 did that thing, boy. Now she about to go down ski.
Yeah, it's gonna be interesting. I'm interested to see what the fuck is about to happen. It's actually gonna be oh, it's going in. It's already starting. The madness begins.
All right, hold on. Let me hop on this stream.
It's 4 hours.
We're watching BTC. I'm about to peep 30. She just smacked my TP3 too, bro. Like literally 3 minutes before.
Yeah, this Bitcoin one got hit not long ago. It was like a little longer than that, but
the Bitcoin trade was fire. I'm not gonna lie, Bitcoin and ETH have been clean lately.
Yeah, they for sure definitely have.
They've been moving.
Watch this fucking position on MetaTrader. Blue number go burnt. Yeah, I'm out pretty much everything though. I have stops above entry to account for slippage.
Fire. Same.
Oh man. Let's see it. Let's see something, JPal. Let me see something.
Actually, I want to with gold. Gold's gonna go stupid.
Yeah, gold always goes crazy.
Fuck, it's in my long zone too.
Yeah, I know. It's always fucking FOMC. It's always in the zones where you're just like, I just can't. Like, there was one time. Let's see, it's 2 p.m.
What the fuck, gold?
Holy gold, bruh.
Okay, pop back up fast.
It just fucking liquidated the lows. I literally just like an hour ago, I just got rid of physical gold, bro.
Nice. Let's see.
God damn that way.
Are you on forex.com as your broker? Well,
no, not a broker, just for news. Why isn't it? Where's the? Okay, they're on. They're as forecasted. It's kind of what I was expecting.
There's the short. God damn, boy. Right into the FEG.
I always just love the energy, whatever. Like, it's like the news is coming. Like, I can just like feel it, even though like even people, not even you guys, I know everybody just like watch with this shit. So what DXY, because DXY is really close to the draw. It's weekly fair value gap.
I just see the reactions, bro. Because it's one thing reacting to yourself, just watching that shit, but then when you're with people and they're all going crazy.
Yeah, oil's moving. I don't think this gap that I had. I think it was a BPR. Or no, what was it, a weekly? No, it was a weekly order block. That's what it was. We're still traveling up in it. Oil's. I really think it's gonna end up. I mean, it came off this low nicely. Let's see it. I'm not watching spoos. There we go. There's that dumpage.
Wow, that shit was to the pip.
Yeah, I was watching everything today just to see kind of study price action, but it was funny. It was like I took a trade this morning, a little scalp, and then I was in and out. I was like, nah, just fuck this shit. But here I was like, usually I would have watched this for a short, like right there. And I was just watching and I was like, it's gonna fucking pump into FOMC. I know it. Look at that. Sheesh.
You looking at ES?
Yeah.
Damn.
What's up, guys, in the chat? I just now saw it. AS, I appreciate you tuning in and welcome to the chat. We're on here almost every day, so. Bjorn, what's up? Abra 4.5. I'm not sure what you mean by 4.5. Holy dumpage. It's going for the PDL probably. You know, I bet XMR's, oh, this is so sad, bro. I wanted to short this instead of Adam last night, and I didn't. I was going to short it. It was like right here. I was messaging Mang. I was like, oh, I think I'm going to short this. It was like right here. It was that candle. I just didn't short it.
Holy fucking 30. That H4. Bro, this shit is so written. This shit is playing beautifully. Peep that 30 and then peep H1, bro. And just look at that FVG.
Yeah, I know, right? Right into it.
Written.
Bearish divergence on GU and EU. Bearish SMT. I don't want to say divergence. Yeah, I'm not. So I always get POIs starting to hit whenever I am in this or whenever we're around these fucking crazy ass new shit. I know some people like Jerry be trading NFP. I'm like, damn, you're a savage. Somebody said, are any markets, any correlated markets for oil to use for confluence? Yeah, the CAD, Canadian dollar, but it's more like Canadian dollar moves with oil, but you can use them together.
Does that mean Bitcoin is shitting too?
You know, it's actually not that much. I'm just judging by my blue numbers on my phone. I've got most of it out. I took most of it. That's why I kept looking. I'm like, I literally was like, is this like not refreshing or something? But it's holding. Yeah, it's holding better than anything else is. Like, I mean,
Literally.
currencies aren't even moving that crazy, to be honest. I mean, like they kind of are. I mean, look at. I think that like it's going for sell stops, but at the same time, you got that bearish divergence GU. They'll probably make another move down.
Wow, what a move.
Yeah.
Doesn't the stream in like what 26 minutes like that also moves it a lot usually?
It can. It's a hit or miss.
Oh, all right.
So like he might be like, you know, he might. Oh yeah, gold is in a buy zone, isn't it?
That shit looks fire, bro.
But it's also kind of like in a sell zone at the same time, the weekly. But I have, that's really not anything yet. It's just kind of like an idea. But I don't really, this POI is not the cleanest either. Dude, my new glasses kind of like fucking hurt wearing these, not hurt, but like they irritate me wearing these damn headphones. I want to get some speakers and then like just turn my noise gate up a little bit on my mic so I don't have to wear these fucking headphones. What is this? Oh, Dems who received donations from Sam Bankman-Fried. Good old Fox News fucking. I like how people post Fox News like it's like even if whatever side you're on, like I'm not gonna get all political, but like if you can't tell Fox News is biased as fuck, like and believe me, I'm not like super left or anything. I think most people that know me know that, but Fox News is like it's so painstakingly fucking stupid. Like it's crazy to me that people like watch that shit. It's like a parody.
Like CNN.
Yeah, they're all like that. Fox News makes themselves look the worst, though. I will say that. Like CNN at least is like kind of intelligent about bullshitting people. Fox News is like, just like, bro, you have to be like, I don't know. I'm not gonna get into that, but that shit's crazy. Like my dad, he'll sit there and like watch it like that. I'm like, bro, like, why are you watching this? Oh, there's bullish SMT divergence on NQ, 1 hour. If it holds, it's way too early to really, you know, use that obviously, but volatility index looking like upside. Sell side's been attacked. Damn, I wish I'd have fucking shorted Banera, bro. What a piece of shit. That's like actually really didn't make that much of a move. We got stopped on those Adam sells. We talked about this in the stream yesterday, so I want to go back and I don't want to just dodge that. We did get stopped on these. It's all right. Damn, they wanted to write a TP, But seemed like I just wanted to dig deeper into that zone. I overall could have just refined the zone. What I should have, and I kind of was a little hesitant about, but I was still trying to be mechanical with the strategy I've been using. Those equal highs were there, and I had a feeling they might be a draw. But it is what it is. Bitcoin made up for that times 3. So the other setup that I was watching, where was it? No. Yeah, XMR. My mind just went blank. The reason I like this, we shorted this the first time from, we're kind of following our order flow in this example. So we caught a nasty short. We trimmed out most of it at this fair value gap right here was where we took most of the profits, and then this low. So we are out of the trade pretty much for the most part. But now look, we're coming back up to that daily supply zone that we sold in because, you know, we're trying to sell with smart money, and just like last time, daily order blocks, daily order block. Not much seems to be changing. So now that I've got this 4-hour displacement to the downside, I'm looking to frame some form of sells from this zone right here. So I'll signal them if we take them in the Discord. For those either on the stream, you can watch this this zone. And I was watching it last night. I refined that daily zone down to this 4-hour, these wicks right here, the sell to buy wicks. On the 1 hour, it's an order block. Rated liquidity into it. On the 15-minute sharp move out, right? We got that closure down there, so that's kind of what I require for, that's kind of answering one of these questions. So he said, what is your steps for setup? This is a great example of that. So we came into our area of interest, sharp move out of it. We look for order flow that's pushing us downwards, and we look to confirm that that order flow remains bearish. So after we got that first displacement down, you can take a fib, and you came right back to optimal trade entry, and then you started seeing more bearish order flow. So that tells me that the overall narrative is down. So we're going to be drawing towards lows, and you have relatively equal lows here, and then you kind of just map out your trade like that. I'm sad that I didn't signal it. I didn't take it either. I was gonna, I took Atom, and that was when they get stopped, and then I didn't take XMR, but it's part of the game. Can't be mad at it. The DXY, God, it's so close to this fucking level. I don't think that it's just gonna, the markets are just gonna dump from here, but I could be wrong. Like they might today, you know what I mean? But I don't think this is like.
We got news tomorrow too. I
Yeah.
think that pumps us back up.
Well, and there's quad witching on Friday too.
Damn. Friday distro? GG's. It's over.
He said, what order block is that? I'm sorry, I don't know which one you're talking about. My bad, I just now saw it. Somebody said Bitcoin knocking out everything. I mean, I guess it really wasn't. No, not what I was expecting. I wouldn't have been surprised. I mean, dude, that one FOMC we had. Fuck, where was it? I think it was it this? I think in September or maybe a little after. I can't remember what. No. Honestly, I can't even remember. It might have been. It wasn't that far ago. But there was one FOMC where Bitcoin went fucking nuts, bro. Like both. I think it might have been something like this, something in here. I can't remember, but it was massive.
Wasn't it like a 13% move or something?
It was something both ways. I remember because I closed like right before, like it was like 150 or something, and right after I was like, damn, I would have been fucking wrecked.
Oh, both ways.
Look at this this fucking video, bro. Holy fuck.
Oh no.
That's so loud. Sorry for the people. God, that is so fucking bad. Look at this fucking guy. Where the fuck is he? Is he like, it's like he's at a fucking hotel, like business suite thing, like where you like go print your shit off at the hotel. Some of the shit I see on social media, I'm just like, holy fuck, bro. Instagram is like cancerous, bro. Like literally, Instagram is so fucking bad. Like, it really, like, really is. So fucked.
TikTok ruined it.
Well, I mean, TikTok's bad. I mean, bad in the sense like just the cringe
Culture.
level. Yeah. It's like it's like the new Facebook.
Yeah. Facebook.
I mean, they own it, you know, so.
They're smart for that.
Yeah, zone looks like it might hit though. Like what's we doing right there? On dollar CAD. I'm not gonna trade it right now, just after that, but So we got 15 minutes to kill. Not too much to really go over today as far as setups. Was a paper trade on BNB. We didn't get stopped on that or anything. I left it there, but I didn't leave anything open for the what's it called? I wanted to. This was gonna be another one right here. Was another paper trade. Maybe I should open that one. Litecoin.
Damn, she didn't hit my zone, did she?
If BNB went through that, it probably no, it didn't. Or yeah, it did. It did trade into this candle. But it's already really traded into these. So I was looking at this yesterday and I was trying to kind of follow this, but we traded in here, but then there's so much going on today. I didn't want to really trade off this. Just delete all this jumbo, because really what I saw was this was the down move that then produced this up move right here, even though it was a mitigation. And then from there, we kind of can refine it to this, but all that's getting cleaned out. Looks like it took this low right into this order block down here. Not really the order flow I'd like to see. Maybe these Bitcoin runners that take me to Valhalla.
Valhalla.
Cardano is not looking awful though. To be. I mean, I don't like this right here. All that, but
Altcoins. ADA would be the only one I would trade, to be honest.
dude, I swear though, XMR is another one, bro. XMR and Litecoin, both of them trade really
XMR's
well.
got liquidity.
Yeah, XMR's fire.
XMR moves. Oh no, you're right about ADA. Hold on. That volume kind of looking crazy too on daily and H4.
Yeah, it looks fire.
And that pump up. See what she does. How's the weekly looking?
Took the liquidity right there. And then we had that optimal trade entry order block right here, but it obviously went deeper than that.
You're getting deeper and deeper.
Oh, I'm fucking tired. I stayed up late as shit last night and then woke up early and drank like 2 fat ass cups of coffee, like this massive cup. It was literally like a half a coffee pot I've drank. I drink like I usually drink. Not it's like probably like I'd say the whole coffee pot. It's not a massive one, but it's like
I took all the beans I had and threw it in one cup.
I'd say it's like 64 like 64 ounces, and I probably drank like 32 ounces. Yes, I am funded. Seahawks. And then also, oh, I already answered that. What steps for setup? Yeah, for setup, I mean, just kind of break it down. Basically, you know, first and foremost is structure. That's going to tell you what you need to know. You need to be doing it on your higher time frames, and then translate that down into your lower time frames. From there, you want to find what kind of points of interest you trade from, whether it's breaker blocks, fair value gaps, order blocks, and then once price, you know, let's say if you're bullish, well, you're going to look for bullish points of interest to then target buy side liquidity, or if you're bearish, you're going to use bearish points of interest to target sell side liquidity. So the whole idea is figuring out the narrative of where price is going and why it's going there. Like if you're in a 4-hour uptrend, a lot of the times the midterm draw on liquidity is going to be the 4-hour high. Some schools of thought will call it a week high, but it's draw on liquidity, week high, whatever. It's just where you think price is going. And then you want to use structure and volume. Like, and when I say volume, I don't mean actual volume, I mean like candle bodies. So like for instance here on the dollar, nice full bodied push up through here. So now if we were a buyer, you know, we were in a higher time frame buy zone, you could say, okay, well this down move is what caused the up move because smart money's buying on the down move. Now you can refine that. You can say, okay, well I want to use the last candle, or you might say I use the biggest candle as far as terms of body size. However you do it, that's going to take testing to figure out what's best. And then once price comes down into your area, then you look for structure to then do the same thing it did here on the lower time frames, and you can layer that as many times as you want until you get the risk reward you want, and you know, target obvious areas of where stops would be. I'm not telling you this is what DXY is going to do. I'm just trying to use this as an example because you can do that on any time frame, but what matters is what context you're in. So your 5 minute might be bullish, but the only reason that 5 minutes bullish might be to retrace a bearish 1 hour move. Because if the 1 hour is retracing or the 1 hour is correcting or moving back into a premium, then the lower time frames are going to have to be bullish to do so. So it's all about understanding context, and if I had to say the most important thing would be multi-time frame structure. That's going to be paramount. So hopefully that was a little cool crash course. Is it all described in my videos? I do the best I can. Somebody asked about Litecoin. So Litecoin had this fair value gap over here. God, these heads. I'm gonna take these headsets off for a second. I'll be able to hear you guys if you talk, but I'm gonna take them off for like 2 seconds. God, that shit hurts my ears with these new glasses. But use H1 or H1 or H4 more for forex. It just depends what I'm doing. If I'm swing trading, I'm gonna use H4. H1's more for like intraday high time frame stuff. For Litecoin, when this daily fair value gap here, if we go on the weekly chart, also in a pretty massive weekly fair value gap. And I think it's also, we didn't touch into the balanced price range just yet. So another potential draw could be that if we do start to move higher, the markets remain bullish. Now that would be a point I would look for a reversal at. Now if I'm going to go down to the daily chart, we tapped in that fair value gap. Relatively equal highs here, so there's going to be a lot of buy stops up there. We did pip the high and then move down, so we're starting to see that bearish order flow. But the main kind of point to get over, or get under, I should say, is going to be how we react to this fair value gap down here. Because let's say price does maintain this bearish order flow, there's a high chance that we're going to reverse there, and then the only point I see are those highs. And that would also push us into that unbalanced price range. So I think Litecoin could be buys either in this fair value gap or at this order block if price bounces off it nicely. You could refine that to like a 1 hour probably to make it a little clearer if you'd like. Again, it's all just kind of like what you like to do. Those would be the zones I'd be watching on Litecoin. Just get new headphones. Yeah, I probably need to, but it's these glasses too. I just got them, but they're pretty like thick. So it's like I feel like they're gonna be like that with any headsets. Because I have a big ass head. So we got 20 or 10 minutes. Yeah, I wrote a thread too for you guys. If you're not on my Twitter, you can go watch it. I kind of try to explain because I've gotten questions from people who don't trade smart money, like, because it always sounds super esoteric and like there's so many condescending overtones in the space and people using like big words to sound smart, but nobody really ever talks about like why it works. And most people that are trying to teach people stuff, they don't even understand how it works. And it's interesting too, like even if you're not trading, I think it's pretty fascinating to understand like the process between liquidity providers, market makers, and composite man, however you want to, whatever you want to, the moniker you want to use. But it's really just a multitude of different financial bodies that are making the markets work against you, so to speak. So go check that out if you're ever curious on what smart money concepts is, so to speak. Yeah, crypto's holding up pretty good. Adam's a hoe for this, but it's okay. Woo, this is another coin that I've been watching off and on. I think they're backed by Binance. It's some kind of like decentralized exchange. Seems pretty bullish still. I like this zone right here. We can get down into it to get some buys. Actually, I'll just use the whole sell to buy range. Oh, you said you wear Bayer Dynamic DT770 Pros, never had any issues. I'll have to look those up. Let's just see. those are. I'm actually curious. Never heard of those. Okay. Yeah, they look, I can already tell just from this little thumbnail, they look more cushiony. These I have are the HyperX. They're good for gaming, but they're not like super, super nice, like studio headphones. These look nice.
I used to run those.
You said you used to have these?
Yeah, the HyperXs.
Oh, yeah, the
Yeah,
yeah.
they're like $50 HyperXs. That's what you could hear in like my first videos and stuff. But I had to get a mic. Now I
Yeah.
just use those like Bluetooth headphones over the head.
See, I use them for like my mic. I have the mic I have is a HyperX too. It's the Quadcast. Like it's like a mounted mic or like a studio mic, and it's pretty good, honestly. It was like
That's the one with
100.
the colors.
Yeah, yeah.
That shit's fire. That shit's fire. I was looking
Yeah,
at this.
I fuck with them. Like it's really clear. Like I get like a lot of people like, damn, like your mic sounds way better than it used to if I haven't talked to them. Because I used to use these for the streams too. And it was pretty rough.
The attached microphone.
Yeah, for the what's it called? The HyperXs.
Oh yeah.
Let me go ahead and get. I always have trouble finding the speech.
All right, brother. I'm about to head. It was good talking.
Yeah, bet for sure.
We're about to get these plays, man. Let's get it going.
Hell yeah. Good old Dixie. Honestly, DXY has like the cleanest chart of any asset ever. It really does. Like it's just it's like easy mode. It's for sure got another little bit down though. Like we might not do it today, but it's gonna move into that weekly fair value gap. And the only thing is though, if we're looking at it from a weekly standpoint, it almost looks like, you know, this would be a bullish power of 3 in the weekly because we're coming out and making that low of the week on a Wednesday. But you know, it's definitely possible. I'm not seeing what we're really. I mean, there's a reaction block, or not reaction, a rejection block on a 4-hour. It's tapped into twice, so yeah, I guess, but it's not really what I was looking for since it's not a weekly level. I did take out these sell stops right here, but you know, we might not go into that, but we'll see. I think the only thing that would make me really rethink that would be a massive push and holding displacement inside this fair value gap. Because you know, your weekly open is still, depending on which one you use, which I use the Sunday open. It'd be a crazy weekly candle for this to go bullish this week, though. The fuck? Oh, sorry, I'm just not seeing some of these alerts. I'm gonna take these off. Is there any video about your challenge, like how much you risk to reward you went for? Now I haven't made a video about that. You know what sucks is I wanted to document it, but it was just too much work, like for me, or maybe I was just being lazy. I just didn't want to video every single day and edit every single day of trading because it was like 50 days. So it was a cool idea, but I was like, that's too much. But so basically, what I was trading when I did my challenge, the first phase, I actually went into some drawdown, pretty bad drawdown, and then traded Bitcoin on a swing trade to get out of most of it. But I don't really like go for a, I guess, fixed risk reward most of the time. On the first phase of the challenge, I didn't, but then the second phase, I was playing like a fixed 2R with 0.5% risk just because I wanted to go pretty easy at it. You know, I didn't want to rush it because I know a lot of people fail phase 2, and I was trading mainly gold in the S&P and some Nasdaq too, but mainly gold and S&P. But yeah, I was trading liquidity raids on those two during New York kill zone. When did I get into trading in ICT concepts? So overall, getting into trading, like the first time I was really like trading anything or like buying and selling stuff was like 2016. But really like focusing on day trading and trying to make it like, my main gig, 2020. And then smart money concept was like early 2021, like ICT and stuff. Like get it, that I had entertained it before and I had like watched it and all, but like when I really started to like grasp it, I should say. Any tips on getting a bias when London sweeps both sides of Asia? Happened on silver today. First off, on days like today, you're gonna have harder time. Let me just do silver futures. But on days like today, you're gonna have a harder time getting a clean bias. Yeah, I mean, so what I would have done here is go on the 1 hour and just kind of ask yourself, like, where is more liquidity resting? Like, so if you have really just an order block up here, and then you've got this fair value gap and liquidity right here. So, like, to me, this would have been where there's more liquidity, so I would be a little bearish, biased, so to speak. It would have been a tricky one because, me personally, I probably would have saw this push and then this push back in. I would have probably sold there, stops here. But you have to take it into account that, it's FOMC day and metals move very rapidly whenever we have these kind of days. So I guess the answer to that would be sometimes it's going to be wrong. You know what I mean? Like you're going to be like, that's the way I look at it. It's never always right. But on days like today, you just want to sit it out. Like as far as trying to go for like the whole like daily profile and everything like super professional price action, you're looking in the wrong place if you're looking on days like today or NFP or CPI, any of that. I mean, it's going to be price delivery, but it's not going to be like taking candy from a baby or anything. Adeliki asked for RSR. I don't like that. I'm not gonna lie. If this would have swept this, I would say we're in a good buy zone, and it still may be. But me personally, I would want to see more than we've got. We've got displacement. Oh, I wouldn't even really call it displacement because all the wicks. So I mean, overall, really, your order flow is pretty bearish. This is the last space where I see a lot of money moving around was up in here. Displacement down. Trade back up into this order block. Again, displacement down. You can use whichever low you'd like. Price trades back up into this order block. Rated liquidity into it here. Oops, wrong tool. What I like to do on moves like this is like watch optimal trade entry. I think this whole zone could have some value. I mean, it's already been tapped into. You might see a deeper push into it. But at the same time, I mean, this is all I would really watch is like maybe this zone up here. It's really not the cleanest price action. Maybe refine that to this 1 hour candle right there. And there's a little bit of a fair value gap. That's probably what I would refine this to. Somewhere in there. It's right around optimal trade entry too. And then overall, if But again, I would be watching Bitcoin too, because if Bitcoin starts to move up more and does stay bullish, I would be wary to short. But overall, I would watch for something like this, entry model. Let me just draw that again. That was terrible. If we get price pushing back up here, I wouldn't just short straight from it. I would wait for that same price action you have right here, but on a lower time frame, maybe like a 5-minute, and then look and target all the lows. And it may have already kind of left the station, so to speak, because price, like, it came down and took that low and immediately pushed back up right to the bottom of this zone. Now, again, that's kind of like drawing a wide zone, but that's really the move up that caused the move down, so to speak. QNT. Use like the Coinbase chart. Oops. There's more data. It wasn't on anything else for a really long time. So yeah, weekly fair value gap, but you're not really. I would say, this is really the impulse move for the most part. You came back right to a premium. At that premium, you got a lot of wicks up here. To be honest, I'd almost want to see this higher before I'd sell it. You go to like a 1 hour and look at this, see what it looks like. I really like this little zone right here. So and the 4 hour structure is pretty rough to really do much with, or the daily, So let's go to a 4 hour. Seems like price is trying to move back up into this area. So comes down. That's a tough one because we have came to a premium. We haven't really tapped into any kind of major point, but that doesn't necessarily mean we have to. We're overall trend is bearish, so we don't want to shoot for the fences. Let's see. Actually, probably. Oh, I'm missing the fucking shit. All right, guys. Overall, I'd wait on that. Let's go ahead and watch this.
Across a broad range. To pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 0.5 percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised.
Also, yes, I am going to do that video on Forex replay. Sorry.
increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy's accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the 5s. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
Gina.
Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 3/4 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the speed, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. And that'll be the key thing. But I mean, for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, we'll get to that point, and then the question will be, how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation's coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE core inflation index, is non-housing related core services. And that's really a function of the labor market largely. The biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
Howard.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe. Yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Nick.
Thanks, Nick Temeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And that will allow us to feel our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report, if it had come out last week, do you think it would have changed some of those forecasts in today's SEP?
No, absolutely not. No, as just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that they know that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Thanks. Rachel?
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the models suggest that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have, ultimately. And that's why the peak rate for this year goes up between this meeting and the September meeting, you see that you see the fact that we've made less progress than expected on inflation. So that's why that goes up, and that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the meeting, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
Do you have a sense of, in order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
So it's very hard to say. You know, you can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Colby.
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, really, for how high we need to raise rates, to how much we need to tighten policy to create enough, restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today. And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
And we're going into next year with higher inflation than we had thought. Right, so we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy is having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market, so that you have, it's not that we don't want wage increases, we want strong wage increases, we just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running, well above what would be consistent with 2% inflation.
Neil.
Thanks. Hi, Chair Powell. Neil, Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
You know, our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally, improves the global outlook for growth and for commodities prices.
And so you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, you know, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. And we've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline. As long as new housing leases show declining inflation, that will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important. And we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report, you don't really see much progress in terms of our average hourly earnings coming down. Now, there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving, down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
Michael, Kate.
Excuse me, Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So, if I think I got your question. So, one thing is to say is I think our policies in getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficient, we think, sufficiently restrictive. We laid out today what our best estimates are to get there. It boils down to how long do we think this process is going to take? And of course, we welcome these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's, we see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but I think we need to be honest with ourselves that there's, inflation, 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go to get back to price stability.
Well, do you think the soft landing is no longer achievable?
No, I wouldn't say that. No, I don't say that. I would say this, to the extent we need to keep rates higher and keep them there for longer and inflation, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not. And if we do, whether it's going to be a deep one or not. It's not knowable. And certainly, lower inflation reports, were they to continue for a period of time, would increase the likelihood of a, so I would put it this way, of a return to price stability that involves significantly less of an increase in unemployment than would be expected given the historical record.
Ryan.
Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy so that the ultimate cost of getting it out of the economy would be very high in terms of unemployment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people. And so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions. And I wish there were a completely painless way to restore price stability. There isn't. And this is the best we can do. I do think, though, that, and markets are pretty confident, it seems to me, that we will get inflation under control. And I believe we will. we're certainly highly committed to do that.
Grady.
Thank you, Mr. Chair. Grady Trimble with Fox Business. You've reiterated today, and the committee has reiterated its commitment to that 2% inflation target. I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're going to keep our inflation target at 2%, and we're going to use our tools to get inflation back to 2%.
Nicole.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level. Like, how do you factor potential exacerbations of inequality into your risk calculations, especially given the K-shaped recovery of 2020?
So I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market. A tight labor market which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we could get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term, we have to use our tools to restore price stability, but we can't. What we have to think about is the medium and longer term. If you think about it, the country went through a difficult time. I think much more difficult than we can think it would happen here, but it really set up our economy for several decades of prosperity. So price stability is something that really pays dividends for the benefit of the economy and the people in it over a very, very long period of time. And so when it is lost for whatever reason, it has to be restored, and as quickly as possible, which is what we're doing.
In the short term, are you factoring in these potential exacerbations in the economy? Are you monitoring?
We do, yes, we absolutely do. We look at, it's our regular practice to talk about unemployment rates by different groups, including racial groups and that sort of thing. We do. We keep our eye on that.
Nancy.
Hi, Nancy Marshall-Genzer with Marketplace. What would you do if the economy slows so much that we enter a recession before we see strong, consistent signs that inflation is slowing? In other words, stagflation.
So I don't want to get into too many hypotheticals, but it's hard to deal with hypotheticals. So let me just say that we have to use our tools to support maximum employment and price stability. I've made it clear that right now the labor market's very, very strong. You're at near a 50-year low. You're at or above maximum employment, in 50-year low in unemployment. Vacancies are very high. Nominal wages are very high. So the labor market is very, very strong. Where we're missing is on the inflation side, and we're missing by a lot on the inflation side. So that means we need to really focus on getting inflation under control, and that's what we'll do. I think as the economy heals, the two goals come more into play. But right now, clearly the focus has to be on getting inflation down.
Greg.
Thank you, Chairman Powell. Greg Robb from MarketWatch. You spoke a little bit ago. You said that the U.S. it looks like we have a structural labor shortage in the economy. Could you expand on that, talk a little bit more about that? And really, are you talking about getting Congress action on increasing like legal immigration, things like that? Thank you.
So what I meant by that with structural labor shortage is if you look at where we are now, as I mentioned, if you just look at demand for labor, you can look at vacancies plus people who are actually working, and then you can take supply of labor by are you in the labor market, are you looking for a job or have a job, and you're more than 4 million people short. We don't see, despite very high wages and an incredibly tight labor market, we don't see participation moving up, which is contrary to what we thought. So the upshot of all that is the labor market is actually, it's 3.5 million people at least smaller than it should have been based on pre-pandemic, just assume population and reasonable growth and aging of the population. Our labor force should be 3.5 million more than it is, and that there are lots of easy ways to get to bigger numbers than that if you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost 500,000 people who would have been close to 500,000 who would have been working, who died from COVID. And part of it is that migration has been lower. We don't prescribe, it's not our job to prescribe things, but I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in a speech I gave a month ago, but I stopped short of telling Congress what to do because they gave us a job, and we need to do that job.
Thanks. Jennifer?
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You say you expect growth of just 0.5% next year. Given that you've said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No. I mean, what we do is we make our forecasts and we publish them quarterly. And if you look at those forecasts, those are forecasts for slow growth, for a softening labor market, by which I mean unemployment goes up, but not a great deal. And you see inflation coming down. You see rates going up a lot. You see inflation coming down. Those are those forecasts, and that's really what they show. We're not. We all, of course, we don't. Talk about this kind of a recession and that kind of a recession. We make those forecasts. The staff runs, and you will see this if you look at the old Teal books, runs alternative simulations of all different kinds at every meeting, and we look at those too. And those will explore different things. But that's just upside and downside scenarios. Of course, that's responsible practice that we've carried on for many decades. But no, we don't. We haven't asked ourselves that question.
We'll go to Jean for the last question.
Hi, Jean Young with Market News. I wanted to ask about the SEP again. If you are reaching peak rates around 5% in the first half of next year and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
So we do know that, of course. That's something that we know and we'd see. But as I mentioned, we wouldn't. I wouldn't see the committee cutting rates until we're confident that inflation is moving down in a sustained way. That would be my test. I don't see us as having a really clear and precise understanding of what the neutral rate is and what real rates are, so that it would mechanically happen like that. It'll be a test of, for cutting rates, I think in the event it'll be a question of, do we actually feel confident that inflation is coming down in a sustained way? Thank you very much.
So, Nice little move out. Like I was saying at the beginning, we attacked that sell side. I didn't think that was just going to be a straight plunge down. Now we're up in this fair value gap. I'm not going to be trading any of this, but you're up, so to speak, in this, getting close to this zone that we pushed down from. As far as equities goes, Euro has made a nice V-shaped recovery. Hold on. I can't hear. Somebody said anything. What's up? Did somebody say something? Thought I heard somebody.
I didn't hear anybody say anything.
Oh, I'm tripping. I didn't have my headset on, so I'm like, my ears are like peeled for it. How's your day been so far, Hunter?
It's been well.
Hell yeah.
We fucking called the bottom on FOMC, like super nice. At 396.33.
You caught that shit? Hell yeah.
Yeah, like I was looking at it, I was like, bro, if it's gonna bounce, like it's gonna bounce right here. I actually didn't trade it until a little later when it got over the low of yesterday again.
Yeah. A
And then I
nice
seen
little
it.
push.
Yeah, it had good moves on both sides. I hit it down and up.
Yeah, that's wouldn't have been bad. One thing I've been exploring is trying to get tighter stops for indices to.
Especially with futures, I definitely have been working that too.
Yeah.
I'm just curious, like, we're still in this damn range in the 4 hour and the 1 hour though.
Yeah. I think NQ actually popped out of something. Or no, hold on. That was before, I guess. I could have swore I remember some kind of divergence. That was probably before it got crazy or something. Still, actually, no. Popped up in there. Yeah, Bitcoin held up pretty nice, to be honest. Gold doesn't look bad. Coming back down to this zone. Let me get this weekly zone off my screen. It's too much clutter.
Those huge ones.
Yeah, it's like just like massive zones. I'm like, I can't have that.
Like, yeah, because I'm actually gonna fucking trade this. Like, so I'm gonna have to be able to work with this zone on a futures account.
Yeah, you know what I'm saying? It's like it's I drew it. Yeah, it's just a nuisance at that point.
Fuck, what a shitty fucking. I'm really disappointed.
Yeah.
I expected more.
I'm happy with the Bitcoin, but other than that, not much.
We only moved about, 10 points on SPY, 9 points on SPY, so it's about 90 points on the ES, I'm sure. But then it's like, we're right back where we started.
Yeah, 90 points exactly. Well, not exactly, but almost.
Close to it.
93.
Yeah. Yep, very, very disappointed.
Yeah, that zone that we were talking about this morning was nice. I mean, there wasn't really a way to execute off of it, but unless you just shorted, like
just randomly,
like on the break or something, right there. But then you'd have got filled. It was, yeah.
You probably your slippage.
I mean, if you're
marketed right there.
I mean, imagine being such a sick bastard. You short at the 2-minute candle. JPAL's or the interest rates just came out. You're like, fuck
right
it.
Before.
Short it. Yeah, the Russell looks like not a dump. Oh,
Hey,
yeah.
was 50 BPS expected?
Yes.
Yes. Yeah.
Is that silent? I don't think I ever heard silent talk.
Yeah. Also, if you could check DXY, we are approaching a weekly fair value gap.
Yeah, no, that's what I've been watching that fair value gap. That's why I said I don't think we're necessarily done all the way dumping, but I want us to tap into that. Like this take out that low. I mean, we did take out, like, the only problem is where it's Wednesday. I mean, it's a high impact news week. You know, if we were gonna be bearish, I would have wanted us to have like a little up move first. The week was gonna end up closing, but I think we could maybe spike into that. But we did take out this low, so I think we're going to get into it. But
yeah, I thought it was gonna happen during the meeting. It was so close.
right? Yeah, exactly. Like that's why I'm kind of like, Surprised it didn't.
Did you hear how he said we've raised rates 425 basis points this year?
Yeah, it's crazy. And then like he straight up, that one statement wasn't good. He said they don't have any what was it? They don't have any intention of slowing up in 2023. I was like, oh,
Yep.
the bulls felt that one. Oh, look at that. Honestly, I just looked in the 4 hour. We just filled the fair value gap on the 4 hour for most. I mean, I necessarily really don't see a for sure bullish or bearish. Like I just don't see it yet. I mean, I'm not trying to say we're super bullish, but I don't see a, you know, total bearish case yet. I mean, like we need to get back above these highs, but again, I mean, we're at that pivotal moment, so.
It's like that range bound type area right now. It's like we don't have.
Yeah, I like the Dow right here. But the Dow took out all those highs, so it's like, fuck.
I'm just trying to find shit. You know, one right now.
Yeah, we need to get back above that pre-FOMC high with displacement for much of anything to be worthwhile.
Yeah, all indices to me look like daily bearish 3 drive right now.
Yeah, that looks gnarly. I just want the 4 hour to break down and then I'll be really like super ready to be bearish, because even the 1 hour doesn't look super. It looks just like lit grabs on lit grabs until we start getting more displacement and holding it down. But I would say that this is probably we're probably end up moving bearish into the rest of the week if I had to go off power of 3, because we put that high in right here, right into that. Sorry, 1 hour. I think it was, no, it was the Dow that had a fair value gap. But up into this order block. Also, we took that high on Tuesday, so we're putting that, we put the high of the weekend most likely on Tuesday. So now, you know, we should start moving back down towards this weekly open and the previous weekly low.
Was today the most high impact news for the
I'd say this would probably today and yesterday, but I mean, we still have retail sales, and then also we have can't even think straight. Quad witching on Friday. We took the previous daily low. I'd say today's probably, I mean, it's only 30 minutes left. We've about got all the juice out of today as far as SPOOs and indices go. Oh, damn, wait, did Link hit? Oh, no, no, no. This is the PO I had marked up. Shit, guys.
Algo looks like it's going to 17 cents.
Algo? I haven't looked at this in a while. Actually, did I? I think no, I haven't. Damn, this shit's got hammered recently, didn't it? Check out that weekly sell side.
I think it's going for the oh, maybe it's different on perps. On spot chart, there's 2 equal lows right at 17.42 or something.
Let me look on the spot chart. Okay, okay, yeah, this is better. Like this down here.
Yeah, I don't know. I was wanting to ask you about that, if that even is anything relevant since
It could be, but I would be, the only thing is like this, like when I look at it, like when I try to figure out like, what the fuck? Was this not, this wasn't just on my chart, was it? Am I like crazy? I don't know. You can tell I've been on this chart in a while, but when I look like where's the point we move the most drastically off of, and I say this, you know, that's where like I really see a lot of sell side liquidity. There's equal lows here, and then here these lows, and then really this, and we moved into that. Now really it's more so the reaction we get coming out of that matters. So we have that daily order block. So you know what we need to see here is like, you know, the 4 hour going bullish here as a start. I mean, this doesn't actually look awful, but we need really, you know, the daily is still pretty bearish. But this kind of looks like grabby. So I would say, like, if you want to look at, I want to see what's in this wick. Yeah, I would say this is like a good draw, like this little up move right there. So we could come up and take out this liquidity, move into that fair value gap. It's still developing. I think it could easily, you know, kind of consolidate kind of fair value gap, take out the lows right there, and then start to maybe give us some upside. I'm gonna add this to the watch list though. I think that was on the spot chart I'm on. I need to redo that TA. Yeah. Wait, what the fuck? Oh, this is the cow chart. And goddamn, if this coin's gonna do something, I'd want it to be here. You could even go a little higher too. I mean, this would be like that low hanging fruit, but we've got this fair value gap. Also this daily order block right there.
We got jobless claims in the morning too, apparently.
He was just talking about how strong the fucking what's it called market is. We'll see.
Job market, yeah.
Yeah.
We'll see.
Kind of like all these highs up here on algo. Fuck, Crunkle. I'll wait for a little more downside. Well, on that note, guys, I'm gonna hop off here. Tomorrow I actually won't be streaming. I am going with my girl out of town to help her with some stuff. She's got to go shoot some stuff for her gig and her work at what is it? Oh, at this car dealer that's out of town. So it's pretty dope. She's actually like shooting like commercials and shit like that with these crazy cameras. So I kind of wanted to go and be a part of that and just see what's up with it. So I'll be out tomorrow. But Friday, I will be live, and then the weekend we'll be teaching our private class in the Discord as usual. If you guys want to get a free trial to the Discord, you can use the code Casper. It's at the bottom of the screen at the link in my description, and you'll have a 5-day free trial, and you'll get a discount if you decide to stay. And also, if you could like, comment, subscribe, all that good shit, it helps me out a lot. So I will see you guys on Friday. Peace.